Maya was 29, renting a one-bedroom apartment in Columbus, Ohio. She'd been saving for years, finally had a down payment, and was ready to buy her first home. She sat across from the loan officer, stared at a 50-page document, and signed. She had no idea what an amortization schedule was. She didn't know why her rate was 6.9% and not lower. And she definitely didn't know she'd pay nearly double the home's price over 30 years. Today, we're going to walk through everything Maya wished she'd known before she signed. Because understanding your mortgage isn't just smart, it could save you tens of thousands of dollars.
At its core, a mortgage is a loan you take out to buy a home, and that home serves as collateral. This is critical. It means if you stop making payments, the lender has the legal right to take the property through a process called foreclosure. When Maya closed on her $280,000 home, she put 10% down, that's $28,000, and borrowed the remaining $252,000 from the bank. The bank technically has a claim on that home until every dollar of that loan is repaid. The portion of the home you actually own outright is called your equity. Every payment you make builds that equity a little more. That's the foundation of how this whole system works.
Here's something Maya didn't realize. Her monthly mortgage payment isn't just paying back the loan. It's actually 4 things bundled together: principal, interest, taxes, and insurance. Lenders call this PITI. Principal reduces what you owe. Interest is the bank's cut for lending you money. Taxes are your property taxes, collected monthly and held in an escrow account until they're due. And insurance includes your homeowner's policy, plus something called PMI, private mortgage insurance, which Maya had to pay because her down payment was less than 20%. PMI typically costs 0.5% to 1.5% of the loan per year. It protects the lender, not you. Once Maya builds enough equity, she can request to remove it.
When Maya was shopping for loans, she had a choice: a 30-year fixed rate at 6.9% or a 5/1 ARM starting at 5.8%. She almost chose the ARM because the monthly payment was lower. Here's what those terms mean. A fixed-rate mortgage locks your interest rate for the entire loan term, 15, 20, or 30 years. Your payment stays the same, regardless of what happens in the economy. An adjustable-rate mortgage, or ARM, starts with a fixed intro period, like 5 years, then adjusts annually based on a market index. The 5/1 means fixed for 5 years, then adjusts every 1 year after. ARMs can make sense in certain situations, but they carry real risk if rates rise significantly. Maya went with the fixed rate, and honestly, for a first-time buyer, that's usually the safer call.
This is the chart that made Maya's jaw drop. It's called an amortization schedule, and it shows how your payments are split between principal and interest over time. In the early years of your loan, the vast majority of your payment goes to interest, not to actually owning more of your home. Look at year 1. On a $252,000 loan at 6.9%, roughly 80% of Maya's payment goes straight to interest. By year 15, it starts to flip. And by year 25, most of every payment is finally building equity. This front-loading of interest is by design. It's how lenders maximize profit. Understanding this is exactly why extra principal payments early in your loan can save you enormous amounts of money over time.
Here's the number that changed how Maya thought about her mortgage forever. Over 30 years, at 6.9% interest, she would pay over $352,000 in interest alone, on top of the $252,000 she borrowed. That means her $280,000 home would actually cost her more than $600,000 when all is said and done. Now, this doesn't mean buying a home is a bad decision. Real estate historically appreciates in value, and you're building equity rather than paying rent with no return. But understanding this number motivates smarter behavior, like making extra principal payments, refinancing when rates drop, or choosing a 15-year loan if you can afford the higher payments. Knowledge is the difference between a wealth-building tool and a debt trap.
To put Maya's 6.9% rate in context, let's zoom out and look at where mortgage rates have been historically. According to Freddie Mac data, 30-year fixed mortgage rates hit nearly 18% in the early 1980s. They spent much of the 2010s below 4%. During the pandemic in 2021, they briefly fell to around 2.65%, an all-time low.
Then they surged rapidly, crossing 7% in 2022 and 2023. Maya locked in at 6.9%, which feels high compared to recent memory, but is actually close to the historical average of around 7 to 8% since the 1970s. The takeaway? Rates move. If they drop significantly after you buy, refinancing could make a lot of sense, but timing the market is rarely a winning strategy.
After Maya understood her amortization schedule, she got strategic. Let's talk about 4 moves that can save you serious money. First, put down 20% if you can. Avoiding PMI on a $252,000 loan could save Maya $100 to $200 per month. Second, making just one extra principal payment per year on a 30-year loan can shave roughly 4 to 5 years off your loan and save tens of thousands in interest. Third, if rates drop by 1% or more, refinancing often makes mathematical sense, though you'll pay closing costs, so run the numbers carefully. Fourth, a 15-year mortgage typically comes with a lower interest rate, and you build equity much faster, though monthly payments are higher. Maya started making bi-weekly payments, effectively one extra payment per year, and projects saving over $40,000 in interest.
Maya was also blindsided by closing costs. These are fees paid at the time you finalize your loan, and they typically run 2 to 5% of the loan amount. On her $252,000 loan, that was between $5,000 and $12,600. Closing costs include lender fees, title insurance, appraisal fees, and prepaid items like your first few months of escrow. Speaking of escrow, your lender collects a portion of your annual property taxes and homeowner's insurance each month and holds it in an escrow account. When those bills are due, they pay them on your behalf. It prevents you from being hit with a huge tax bill all at once. One thing Maya wishes she'd done earlier: shop at least 3 to 5 lenders. Even a 0.25% difference in interest rate can mean thousands of dollars over the life of the loan.
Here's a number from the Consumer Financial Protection Bureau that every homebuyer needs to hear. Research suggests that borrowers who get quotes from multiple lenders can save an average of over $10,000 over the life of their loan, simply by comparing rates and fees. That's not a refinance, that's not a major life change. That's just picking up the phone and calling a few more banks. Maya only got one quote initially. When her real estate agent pushed her to shop around, she found a lender offering 6.65% instead of 6.9%, a quarter-point difference that saves her over $13,000 over 30 years. This is educational information only. Always consult with a qualified mortgage professional for advice specific to your situation.
Maya closed on her home and started her mortgage journey with eyes wide open. She knows her PITI breakdown. She understands why early payments are mostly interest. She made bi-weekly payments and plans to refinance if rates drop meaningfully. And she got 3 lender quotes before committing. Here are the 4 things to take with you today. First, always calculate your full PITI payment, not just principal and interest. Second, pull your amortization schedule and understand where your money is actually going. Third, shop multiple lenders. Even a fraction of a percent matters enormously. And fourth, extra payments toward principal, even small ones, compound into massive savings over time. Mortgages are one of the most powerful financial tools in America, but only if you understand them. Don't sign what you don't understand.
Everything in this video is for educational purposes only and does not constitute financial or mortgage advice. Maya is a fictional character created to illustrate real financial concepts. Please consult a licensed financial advisor or HUD-approved housing counselor before making any more